This is the Daily Market Rundown live from the Tradelo trading floor. It's May the 1st. Some highlights from today's show. The US has now reached out to China. US recession odds are rising, and US initial jobless claims are now in focus. Happy 1st of May to all of you, and for those of you that are of course within Europe, I hope you're enjoying the day off. What that does mean of course is Eurex products are of course closed today, but we do have a pretty normal session in the US, so there will be a little bit of opportunity scope within the afternoon, and we'll talk a little bit about that over the course of today's session. Now with that in mind, let's get across and talk about our first topic today, which is the fact that the US has now officially, or somewhat officially, it's not been verified yet, they've reached out to the Chinese, waved the white flag to get talking on tariffs. Now, you've got to take this with a pinch of salt, because we've heard lots of back and forth over the last couple of days about the fact that the US and China have been talking. It's of course been refuted by the Chinese Communist Party. They said no talks are going on and stop muddling the information because you're confusing people. Now again, I have to stress, yes, there has been this time from a Chinese state media that the US has reached out, but very important, this Yuyuan Tantian outlet is not a verified Communist Party outlet. Okay, so it's very much the market's kind of thinking this is a bit of a rumor. It could be true, it might be true. Ultimately, at the end of the day, we just don't know. Okay, of course, this can be played down. If it is played down over the course of today's session, we'll see a little bit of a negative reaction to that. But again, this is kind of old news. Okay, I think this idea that the Chinese and the US are going to talk, that's pretty much expected. They have to talk. Why? Well, because you cannot have tariffs where they are, because there's simply just no trade taking place. Okay. The point is they are going to talk. If they talk, it doesn't necessarily mean anything. Why? Because the Chinese have said very clearly, get rid of all those tariffs and then we can talk. That is the red line. If the US comes out right now and says, we will remove all tariffs on China, then fine. You'll get a very, very positive risk-off move. But until they say that, you're not going to get anything better. And of course, the Chinese are reluctant to talk until those tariffs are removed. So it's very much a stalemate. We've been talking about this for the last couple of days. So it's very much a stalemate. Now what that does mean, and we'll keep reiterating this until it happens, when you have a stalemate situation, it means one side has to force the other side. Now it's most likely that the US is going to force China, and they're going to do that by trying to embargo certain goods. Okay, they're going to up the ante, they're going to up the rhetoric, make it a little bit more difficult for the Chinese, and try and force them to the table. Okay, so I suspect that's the next play in all of this, is a little bit of an embargo on some of the key products that the Chinese are importing tariff-free, and I suspect that will come. Not necessarily, I think yesterday I said it might come this week, and I think having thought about that a little bit more, I think that'll typically come perhaps, as we see the equity market stabilizing, as we see bond market stabilizing, I think then we may eventually get this sort of upping the ante or a little bit more aggressive rhetoric from the US. Why? Well, because when vol's low, of course, ultimately if you come out with a little bit more of a sort of a forced situation where you try and force the play, you're not going to get sort of a panic type move. Okay, sure, S&P will be down 1, 2, 3%, but if we were in a 40 or a 50 vol environment, and you came out with a comment like that, you could create some very, very difficult scenarios. Okay, so again, I think it's something that perhaps we get next week, maybe over the weekend next week, but I think it is definitely one of those things to keep on your radar. Now, what I like to do, of course, at the start of every month is take a look at ultimately what the markets are doing, what the key macro markets are doing. When I say macro, think equity indices, think some of the risk-off type markets like gold and 10-year bonds, what some of the key commodities are doing like oil and copper, and then of course, what's our Mag 7 doing, and what are the likes of some of the currencies doing. I really like to do that review just to make sure that I have a very good understanding as where there is trend, where there's sensitivity, and ultimately what's leading and lagging. Okay, so this is an exercise definitely I encourage, but for today I think it's very, very clear what we are seeing. It is very much a case of Europe is performing very, very well this year. We can see with the likes of the DAX and the CAC they're both up. double digits this year. Okay, well, not the CAC but the FTSE. So we can see a very positive Europe this year, and if we contrast that to the US, we can see the US is kind of down very aggressively. Okay, if we zoom into the US, we can see it's very much the Russell leading to the downside. Why? Well, because this tariff shock is very, very impactful on the US economy. Okay, so the economy type index, which is the Russell, is very much being sold more aggressively relative to something like the S&P 500. Okay, and then of course, if we look at some of the Asian stock indices, we can see that they are a little bit more mixed. And again, we can see China struggling the most. Why? Well, because they are heavily impacted with the current tariff situation relative to, for example, the Japanese and South Korea. Okay, so I think that's the key takeaway, is that it's kind of this idea of if you've got a deal, if you've negotiated a deal and your tariffs are going to be low, your stock market's generally going to do well. And of course, right now, the general sort of consensus play is that Europe is going to keep outperforming the US. Why? Because they're cutting interest rates, because they're spending a lot of money. You can see in Germany, they're ramping up spending. They're also ramping up spending on defense spending. So there's a lot of spending, a lot of fiscal policy as well as monetary policy that's enabling Europe to outperform. And at the same time, we're seeing the opposite effect in the US, which is high interest rates and a fiscal policy that's effectively tamping down on demand and ultimately economic growth. Okay, so that's the play for the rest of this year. Is buy Europe, long Europe versus short the US. I suspect that play stays well into the year. What that does mean, of course, is we'll see continued sell side pressure in the dollar as we see just money start to flow back across the Atlantic into Europe out of the United States. And then if we take a look a little bit, zoom into our Mag 7, our tech stocks, and we try and find who's leading, who's lagging. Well, again, I think it's quite obvious that this year it was very much about semiconductors and just chip stocks in general getting hit very hard. Why? Well, because they massively outperformed over the last 2-3 years. Okay, they were the massive outperformer, as well as, of course, the whole DeepSeek thing did really shake up the whole AI space. And when you have a very over-speculative market that's driven on sort of a lot of hype and not much in the way of returns from big companies, then sure, we are going to see NVIDIA underperform the rest of the Mag 7. That being said, we can see the likes of Amazon also massively underperforming, very closely linked to consumer discretionary. At the end of the day, if people got less money to spend because of tariffs, well, Amazon's going to get hit pretty hard on that. The likes, of course, Alphabet, as well as Microsoft. Again, search is going to typically do well. Do underperform in terms of marketing when we do have some form of recessionary fear. So that makes a lot of sense. But on the flip side, we can see that the likes of Meta continues to be the best performer, as well as Microsoft. They continue to outperform the general market. So again, just gives you a general idea. When the markets start to sell off again, you want to really pay attention to the likes of Amazon to the downside, as well as, of course, Apple to the downside, because these are very much consumer discretionary type companies. Whereas when we do rally to the upside, the likes of Meta and, of course, Microsoft are the ones that outperform. Now, with that in mind, let's turn our attention and talk a little bit about the GDP report yesterday. It came in bang on the screws, and I think that was important. I think there was quite a wide view of what the number could come in as. I know Morgan Stanley was thinking -1.5. Goldman Sachs was also thinking negative print. So there was quite a wide consensus of what we could get, and I think the fact that it came in bang on line, that was positive for the market. Okay, I think it was sort of almost a sense of relief, which is why I was quite surprised that we initially sold off post the data. We of course did get that squeeze later on the day, and I suspect that was just some of the smart money stepping back in to kind of push some of those shorts out of the market. Now, the key thing to take away from that GDP report is that we learned a great deal of nothing. Okay, there was really nothing to take away from it other than the fact that consumers are still holding up relatively well. I think if you look at the consumer spending part of the report, I think it was 1.8%. That doesn't suggest a consumer that's completely tapped out yet. Now, sure, recessions can turn things around pretty quickly, but the reality is everyone's got a job still. And if everyone's got a job and wage growth is still rising, the reality is people are still spending to a degree. Okay, now uncertainty, of course, can change that in the heat of the moment. We can literally go from one GDP report to the next and see a complete drop-off within consumer spending because that is the nature of recession. But I think the key takeaway yesterday was the data was good. It was a good data point for Q1. There was nothing in there that scares the living daylights or that suggests that right now we're falling off a cliff. Okay, and so like I've said for the last couple of streams, it's going to come down to the hard data. It's really going to be a month by month. What's the non-farm payrolls doing? What's the manufacturing data doing? What's the JOLTS data doing? What are these data points doing? What's the inflation prints doing? Okay, those are the kind of data points, the hard data that's going to show us in real time when we have found a recession. Okay, we've also got another data point today that we'll talk about, which is initial jobless, which I think, again, it's going to tell us, it's going to give us a very good lead as to when all of a sudden the likelihood of a recession is increasing. Now, with that in mind, I think it's very important to pay attention to some of the gambling markets. We can see Polymarket is very much showcasing, just the general idea from, let's call it retail traders, because that's what they are, the general idea of a recession and the odds of a recession this year. And I kind of want to just zoom back and, all the way to sort of the start of the year. Before the tariff talks begun, we were sitting around a 1 in 5 chance, or 20% chance of a recession. Okay. Now, coincidentally, you can see it kind of coincided with the top in the markets. Okay, we can see that the S&P was trading, roughly speaking, about 3% higher before we started to see that odds of a recession tick up. And of course, that's probably because smart money was already selling out at the start of this year. Okay, the point is that we can see there is a relative correlation between, of course, the odds of a recession and the S&P 500. We can see when Trump's Liberation Day came in, those odds really moved quite aggressively, all the way from around 40% to call it 65%. Okay, and at the same time, yes, we did get that very aggressive sell-off. Okay, now the key reason why I've overlaid these two charts is I just want to point out that the odds of a recession have dropped somewhat from 71 to call it 61%, okay? But we are still pretty much around those highs made when Trump announced those tariffs, okay? At the same time, of course, we have seen that dead cat bounce in the S&P 500. In other words, right now, risk reward is starting to favor very much short side trades, particularly as that hard data comes in, okay? And I think that's key. Going into tomorrow's non-farm payrolls, I don't think there's anyone that wants to be long the market. I think everyone wants at least a hedge into that. And so I suspect today/tomorrow, we are going to see a little bit of sell side action come into the equity indices as people do hedge into that key data point. Now, sure, non-farms come in line tomorrow, we'll squeeze out those shorts again, and we'll perhaps go and fill up all the way to that 57.50 area in the futures, perhaps. Okay, if the number comes out weak, all right, that's the first data point, or the first hard data point that is effectively the market's going to run on, and it's going to very much get to work in pricing in, again, the odds of a recession increasing. Okay, I think that's very, very important to stress, and so do focus, of course, on ultimately that non-farms tomorrow. We will talk about that in tomorrow's rundown. Now, recessions. Let's talk a little bit about recessions, because you don't have to call a recession. Okay, you don't have to be the guy that goes on Twitter and says we're in a recession to make money. That's not how it works. The important thing to do ultimately is to go back and have a look at the last couple of recessions, and I do hate this exercise. I always sort of suggest, if you are going to look back to history, don't lean on history too aggressively. Lean on it for some insight and some understanding, but make sure that you take what you can from history, but nothing's ever the same as it was in the past, okay? But the key thing to stress ultimately in terms of looking back is we can go to 2000, we can go to 2008, we can look at 2020, and we can look at the current year. They're all different recessions, okay? And obviously I'm assuming we're in a recession, but they're all different recessions. They'll all look different, they'll all smell different, and they'll all come out of nowhere. Okay, you'll never know that we're in a recession until the market tells us we're in a recession. But what I do want to stress is that all recessions typically, if you go back in history, would take quite some time. And we can see they've initially in 2000, it took 10 quarters, so 2.5 years we were in a recession. We then had 6 quarters, so 1.5 years in 2008. We then had 1 quarter in COVID era. The 2020, I wouldn't call it a recession, but let's call it a dip or a correction. Ultimately, it was a slowdown in growth all the way down to 1%. Okay, so again, call it a slowdown in growth, not a recession. That lasted all of 4 quarters, and currently now this correction is 1 quarter long. Okay. The point I want to stress here is that if you go back to early 2000, the reason this recession lasted that long, or this correction lasted that long, was because there was no fiscal / monetary response, or at least the fiscal monetary response was not aggressive as it has been in current years. Okay, if you fast forward to 2008 again, the fiscal response was not that quick, and of course monetary policy was not slashed that quickly, and QE didn't start that quickly. Okay, QE 1, 2, and 3 took about 4 or 5 years from the Fed. So again, still a 6 quarter dip or recession or whatever you want to call it, and that's because there was very little policy response. We look at 2020, and what's the key takeaway? Well, the moment COVID hit, we of course had an aggressive fiscal response as well as monetary policy, zero rates, QE immediately bazooka. Okay, and that's why 2020 lasted such a short period of time. It lasted all of 1 quarter. That was it. Okay, moreover, we can see the longer it lasts, we had an 81% correction in 2000. We had a 40% correction in 08. We had a 10% correction during COVID, and of course we did have a 32% correction in the 22 sort of bear market correction. Okay, the point is that the longer it lasts, the more uncertainty there is, the deeper the contraction. Okay. Now, why am I mentioning this? Because the last couple of streams we've spoken a lot about this idea of uncertainty. Now, the fact that Trump has given us a 90-day extension, the fact that we see the likes of China willing to play the long game, the likes of Europe willing to play the long game, the Japanese willing to run the clock down, that just ultimately means that this correction is not going to be a 1 quarter thing. Moreover, like I said, there is no fiscal response right now, and there is no monetary response coming from the Fed either. The point is that you're not getting anything supporting this market, and we've got an existing amount of uncertainty that's not going away for the next at least 1 quarter. The point is that this is very much a bear market rally, and this is very much something that's likely to continue. Okay, so just make sure you go and study those recessions. Understand that the depth of the recession and the time it takes is ultimately going to be dependent on when that policy certainty returns. Okay, that is the key thing to any recession. Now, we are not necessarily in a recession yet. We could be in a recession. I'll tell you when we are, and the point at which we're in a recession is when the Financial Times or the Bloomberg says we're in a recession. Okay. But what you must know is when we are in a high degree of uncertainty with no policy responses, those periods typically will lead to sustained bear markets. And I think that's the key takeaway from this chart. Now, with that in mind, we have almost retraced the entire move of ultimately the day that Trump came out and told us that he's going to impose tariffs, reciprocal tariffs. We're 0.8% away effectively from where we closed on the future space. Okay, like I've been talking around, I think 5,700 is absolutely the most important level. Do we get there today? Perhaps. Do we get there over non-farms? Perhaps. Don't be afraid to settle up their non-farms. One of the key things you'll learn about key data points is that markets do typically turn on key data points. Okay, don't be surprised to see us trade up here on non-farms tomorrow or even today, and that being a massive turning point for the market. Now, what I want to stress is that the risk reward at this point is becoming very, very good for short side trades. The bear market rally seems to now be approaching the kind of levels where you do want to be getting short. In terms of downside targets, and like I said, I think you've got some fantastic risk reward opportunity here. We've got a gap here at 5,300 that needs a filling. That's a good 400 points away. So very basically, if you're short 5,700 with a 100 handle stop, you're talking about 4-1 with a massive stop. Okay, you're talking about almost at what, a 2% stop to make 5% in terms of when that market rolls back down. Okay, and I think that's the key way to look at this market now. If you think uncertainty is the primary narrative, if you think ultimately it's all about risk reward, right now bets favor very much short side trades in the S&P, in the Russell, in the Nasdaq. Okay, and again, the key market to pay attention to is of course the Russell. Why? Because it's the most sensitive on the way down. Like I said earlier, Russell to the downside, and if you're going to start trading some of the Mag 7, the likes of Amazon and Tesla, that's where you're going to get your best bang for buck. All right. And then finally, today, of course, we do have initial jobless in view, and I think this is definitely one to pay attention to. Again, it's not something that ever moves, but at some point it's going to move. What we're looking for as traders, okay, it is a weekly print, but what we're looking for is something around a 250 mark. Okay, I think initial jobless that comes out at 250 today is really going to raise a couple of eyebrows. It will be one of the highest prints we've had since that hurricane impacted initial jobless print back in September. So again, anything above 250, you're going to see some concerned markets. You will see some very aggressive moves to the downside, particularly in the risk markets. And then, like I say all along, the risk off markets, the likes of gold and the likes of German bonds, they will outperform in that sort of scenario, as well as we will see some underperformance in the likes of the dollar and the US equities. All right, that's then it for today. Like I said, it is a European session that is not with us today, so there's very light volumes in Europe. So some of the signaling, I think this is key to stress. Yes, the S&P is up quite a lot, but it's up when no one is sitting at their desks in Europe. So very much ignore the overnight moves, can retrace itself quite aggressively. Otherwise, if there are any other questions, do post them in the Discord channel. If you'd like to comment, we do appreciate all the comments. Comment, tell us what your thoughts are on the recession. Are we in a recession? Are we not in a recession? Otherwise, good luck out there today. Manage that risk. Go make some money.